Okay, now in this video, let's see what is working capital and major components and things related to working capital. Before going deeply, we should know what is the meaning of working capital. Working capital refers to the part of the capital required for the meeting business short-term needs. Okay, so it is a part of the whole capital. What is capital? Capital is the investment that a owner makes in his or her own business. It is an investment. Okay, out of the total investment, a small part is used to meet the short-term needs. Okay, or it becomes the part as a current asset of the business. So, working capital is that part of capital which is meant to finance short-term needs of the business. So, working capital generally includes, see here, cash, inventories, debtors, and marketable securities. All these things together form part of working capital. As defined by Gustenberg, working capital is circulating capital. Okay, remember, since the working capital keeps rotating within the business, it is also known as circulating capital. Once we have some working capital, it is converted to something else. Once again, it will be converted back to working capital. It keeps rotating. Since it keeps rotating, it is also known as circulating capital. Okay, Gustenberg, a person, has given a definition for working capital as circulating capital means current assets of a company that are changed in the ordinary course of business from one form to another, as from cash to inventory, inventory to receivable, and receivable into cash. So this is called the cycle of working capital. First of all, we will have some cash with us. The business will have some cash with that. With this cash, the business will make some inventory. Okay, inventory means what? The stock, the finished goods of the business. From this inventory, some part will be sold for cash, so once again it become cash to the business, but some other part will be sold as receivables. That means what? That will be sold to our debtors. They will pay money laterally. When they pay the money, once again it become cash. So this is called the cycle of working capital. From cash to inventory a part become cash, the other become receivable, and from receivable back to cash. This amount keeps rotating within the business, so it is also known as circulating capital. See, we have told before the basic components of working capital are cash, receivables, and inventory. Do remember that. So basically there are three concepts of working capital. We are moving to the important part. We just saw what is working capital. Now we are moving to what is the concept of working capital. There are basically three concepts of working capital, out of which one concept is accepted globally and it is taken in finance as the basic or the most important concept of working capital. The fund flow statement of a business is built upon this concept. Okay, now we can see all the three whole concept, and from that we can see which concept is selected as the best one. The concepts are gross working capital concept, net working capital concept, and zero working capital concept. First of all, gross working capital concept. According to this concept, gross working capital is equal to the sum of current assets in the business. Okay, so this concept data says that if we want to find working capital, we need to just get the sum of current assets, which all are the cash, receivables, inventory, and marketable securities. We have told before, these current assets, when we take the sum of these current assets, we will get working capital. But the next concept, net working capital concept, says something different. It says that working capital is equal to what? Current asset minus current liability. Everybody please remember that this is the best ever concept developed about working capital. So this is accepted globally. And for fund flow statement, we take this concept, the net working capital concept, as the concept of working capital. It says that current asset minus current liability is working capital. So it means that the fund available for running the business is the amount means the total of current asset after paying all current liabilities. So it will be the amount immediately available for the business. So we can call it as a working capital. So remember, net working capital is accepted as the best concept of working capital. We have another working capital concept called zero working capital concept. Here this is the most modern concept, that according to this concept current assets are always equal to current liability. So there is no margin in between. Even though we discussed three concepts, remember the second one, the net working capital concept, is the best one, and whatever we learn afterwards is based on this concept of working capital. Now we can move on to most important thing, the factors affecting working capital. Now we have told about working capital is the amount that the business need to run daily business, or it is the sum or the difference between current assets and current liability. Now every business need working capital. Every business that has an operation needs working capital, but how much working capital should one business have? It differs, isn't it? If you have a margin free native, it will have a working capital. If you think about Tata, it will also have a working capital, but the amount, the volume of working capital is different. Now we are going to see what all factors determine the volume of working capital to be kept by a business. So we are going to see the most important factors, and the very first factor is nature of business. Some business will require more working capital because it would have daily production. Think your nature of business is what? Something that produces daily. That means you are a manufacturing business. Then you will need more working capital available for your business. Same time, if you are not manufacturing, if you are an intermediary, there you will not need much working capital because you will stand in between the payment made by someone and to be given to someone else. So when you are a manufacturing business, you will need more working capital compared to other types of business. Then the most important factor is size of the business, that we have told before. A margin free near to you will also need a working capital. A small shop near to you will also need a working capital. The company Tata will also need a working capital. But the volume of working capital here differs because the volume of production, volume of activity, volume of operation is all different in these companies, so in these businesses. So the size of the business also determine how much working capital do a business needs. And the volume of sales, irrespective of the company size, the business will have huge sales. Sometimes huge companies will be having very low sales. At the same time, a small company will having a high amount of sales. Irrespective of the size of the company, the volume of sales also determine how much working capital do a business require. The next point is terms of purchase and sales. Think your supplier, someone who is supplying to you, gives you enough credit. Okay, if that person is giving you enough credit, you needn't keep much money with you. But if the supplier is not ready to give something in credit, they are telling, if you want something, just pay us. Okay, if they want us to clear every bill in cash at real time, what we'll do? We need to keep more cash with us, isn't it? Same time, think we are giving to our buyers. Some buyers we are just giving them as our debtors. We are not receiving real time payment, but what? We expect them to pay in future. That time, remember, the income we expect from sales will be delayed. So for making all other payments and all, we need to keep more money with us. So in this point, you need to think of two things. If we can make enough credit purchase, okay, if we can make enough credit purchase, we can have very little working capital. If we are not allowed to make enough credit purchase, we need more working capital. If we allow credit sales, if we give more credit sales, we should have more working capital with us because the payment from sales will be delayed. If we don't allow much credit sale, we needn't have that much working capital with us. Hope the concept is clear for you. Now the fifth point is the inventory turnover. How often do the stock turn into sales? Okay, if it is something moving very fast, think our product is something that moves very fast, then we need to have enough working capital. If it takes time to convert into sales, if it takes time for our inventory to convert into sales, we can rest. Okay, we can have a comparatively small amount of working capital. Why? Because it takes time. And the receivable turnover means what? How what time, okay, within what time do our debtors make the repayment? If they take more time, means the payment will be delayed, so we need to have more working capital with us same time. If our receivables, that means that our debtors are making payment on correct time, we needn't bother about keeping more money with us, because we will receive money from whom? The debtors, or the bills payable, sorry, bills receivable. Okay, so how often do they make the payment? How within how much time do they make the payment? All these factors also what influence how much working capital do our business need to keep. Now the production cycle. If our production cycle is a lengthy one, think our production cycle has enough length, that means what? It will take more time to for the raw material to become finished product. So to run the business in between, only after making the finished product we can make the sales, only after making sales we will get income. So to run our business operation in between, we need to keep more working capital. If our production cycle is very short, think it takes just one day, we can easily make the sales, so we will get income very soon. If our production cycle is short, what? Then we can have less working capital. If we have a lengthy production cycle, we need to keep more working capital to ensure that our production is not interrupted. And the liquidity and profitability of the business. Think our business is much liquid, that means what? There are much current assets in the business. Then what we can do? If there are much current assets, we can easily convert them into cash, that means our business have more liquidity. If our business is much liquid, we needn't worry about availability of cash. We needn't keep much amount as cash itself. We have some assets, let it be marketable security or something else, that easily convert into cash. Then we need to less worry about our working capital. But at the same time, if we are not enough liquid, if we don't have much liquidity in the business, that means we should consider much working capital to ensure our production goes in a smooth way. Now the business cycle should also be considered. We know business cycle is the what? It is a graph that shows the position of the business over years. Okay, think our business is in this stage. This is the introduction stage. We needn't have much working capital, but when we are passing through this stage is called the growth stage. We will be having more demand. When our demand keeps increasing, we should keep enough working capital with us. But when we have reached the peak means the point where the growth ends, it is also known as saturation point. When the peak of the cycle is reached, we should understand that whatever working capital we have, we can't increase our sales. It is a situation like that. So having more working capital is not worthy there. Same time, when we have a recession means that is a fall in demand of our product. When our demand of our product is falling, we have nothing to do there, so there also working capital requirement will be low. Going like that, we will reach a end point called trough. In trough means we will not our demand will not go down after this point. That means we are going to recover from this point. So when we realize that we have reached our trough, we should keep more working capital, because sooner or later our demand is going to rise. So business cycle shows the demand of product with the passage of time. Okay, in each position we need to act accordingly. Okay, so working capital requirement varies according to the position in the business cycle of the business. Finally, the value of current asset. Having more current asset is not important, but having current asset that have more market value, okay, that is easily sellable or tradable in market, that gets enough market value should be considered. If we don't have current asset with market value like that, we should consider some more working capital as cash itself, isn't it? So because current asset include what all? It can be inventory, it can be marketable security, whatever it may be. Our whatever we consider as current asset should have enough value. So these are the 10 points. The 10 points we have discussed are the major factors that determine working capital requirement. So in this video we saw what is working capital, what are the factors influencing working capital, what are the components of working capital, and the major concepts of working capital. Remember the second concept, net working capital concept, which says working capital is equal to current asset minus current liability, is the basic concept we have accepted in finance. Hope it was clear for you. If you have any doubt, please let me know. Thank you.